And Lindsay, we'll start with you on this. Just this question that that was raised yesterday, that Stan Druckenmiller brought up, the issue of a hard landing. He's looking at that as a much more likely scenario, says that that is his base case at this point. How about you?
Well, I think it was pretty interesting that he was waiting until 2023 for that hard landing to occur. When we look at nearly every sector of the economy, say for the labor market, it does seem that we can check that recessionary box. And so I do see those recessionary conditions potentially setting in by the end of this year, with the NBER as a look back, declaring that technical recession beginning potentially as early as the second quarter of this year. And so I do think, again, the Fed raising rates at this aggressive pathway and looking to their forecast of still being able to maintain positive growth, a very minimal uptick in the unemployment rate, seems at odds with the reality of the potentially very significantly negative implications that a further backup in borrowing costs, be that 100 basis points, 125 basis points, will have on the domestic economy.
Although, Lindsay, I don't think that Stan Druckenmiller was of the opinion that they need to stop at this point. I think his point was they needed to start a lot earlier. The Fed's looking at this, not saying, hey, we're raising rates because the economy's great. They're raising rates because inflation is raging.
Oh,
and
absolutely.
They need to get that under control. So what's the Fed to do at this point?
Yeah, they certainly were behind the curve. And while arguably they shouldn't have accelerated the pathway of rate increases by the end of 2021, they did need to remove their foot off of that crisis level of policy. But remember, they were still talking about transitory near the end of last year. And so it took the Fed quite a while to grapple with the fact that inflation was becoming more broad-based. So at this point, I agree, the Fed has very little option other than to continue to raise rates. But as we approach the 4% level, that is likely enough to curtail the demand side of inflation. And the Fed needs to recognize that that's a good holding point, because a further backup in borrowing costs at that point does little to address the supply side, but will all but ensure recessionary conditions.
When you say that you see a recession happening right now, maybe even as early as the second quarter, how deep of a recession are you talking? I realize that depends on what the Fed does from here, but what's your base case scenario at this point?
Base case scenario is a drop of 2% growth as we look to the second half of 2022. So looking at that in a broader perspective. As we roll into 2023, assuming the Fed does recognize the limitation of monetary policy on the supply side of inflation, and they're willing to hold steady at 4.5%, I think by the second half of 2023, we do start to talk about a return to positive growth. So at this point, our base case is a relatively brief and shallow recession. But again, depending on how aggressive the Fed becomes, that could quickly change to a more prolonged or deeper downturn.
Sam, let's just talk about the markets and the volatility and the downward pressure we've seen this month. September has not been kind to equity investors.
Oh, and you're absolutely right, Becky. Interesting, but typically in September, we have about 20 days in which the market trades by 1% up or down. This time around, it was 56 times, so more than 2.5 times the volatility. And history says it's probably going to get worse in October, which traditionally has 36% more volatility than the average for the other 11 months of the year. So I don't think that we're done yet. And as a result, a lot of volatility likely to come.
The other thing that Stan Druckenmiller said yesterday that I think had everyone in the room kind of sitting on the edge of their seats was this idea that you could be invested in the indexes, and 10 years from now, you may not have made any money from where you are right now if you just let it ride.
Well, that would imply that we do have a Great Depression kind of a follow through. From September of 1929 through the fall of 1954, we ended up really just getting back to break even. And I don't think that we're going to have to experience anything like that. But I do think that we should be telling ourselves that we're not going to get the kind of returns we have in the past. On a rolling 10-year basis, the S&P posted compound annual growth rate of about 14% before this bear market got underway. And if you look to what is normally the case over the last 100 years, we should be closer to 7%. So certainly the 10-year trajectory is likely to be coming down, but I wouldn't necessarily say that we're going to see a 70s environment all over again, which only saw a 1.5% compound annual growth rate for the entire decade.